have. I think Americans understand gold the least. I think most Americans either don't think about gold at all, or if they think about it, they think it's a joke and they laugh at it, that it's the sort of thing that over-the-hill former celebrities are pitching in late-night infomercials, usually selling either greed or fear, how rich you're going to get, and they guarantee the gold price is going to have to go up because the Fed is about to print, or fear the Fed is going to crash the economy and there's a threat to your family and your loved ones, or whatever it is that they try to paint it to be. And so there's a lot of tarnish on the reputation of gold in America. That said, Americans are very fortunate in that we've never had a currency crisis. We've never had any serious reason to question keeping your savings in dollars. I mean, we had that episode in the 1970s, inflation being, 13% or 15% or whatever. The rest of the world would say, oh, 13%? Was that per year? Oh, that's cute. You think that was bad? Because there are places in the world where that's per month or even per day, So in the rest of the world, I think people understand gold is for that portion of your savings that you don't want to have at risk. Whereas in the U.S., particularly, but in the Western world, to varying degrees, they regard gold itself as risky. I mean, you could buy it at $1,750 and its price could drop, oh my God, calamity, to $1,700. And then what are you going to do? And, so there's kind of a short-term thinking combined with, kind of an implicit belief that the dollar is the unit of measure and gold is going up and down. But I think before this is all over, even Americans are going to rediscover that they've got it backwards.
What are perhaps two or maybe three of the biggest arguments you've heard against having gold? I mean, maybe you've heard it through the course of business, or maybe you've heard it at the debate. But what would you say they are, and how would you maybe counter or maybe even agree with it?
So I guess classically, gold is volatile, therefore risky, right? So if you're a regulated investment advisor, you're always under a fiduciary duty to use reasonable and prudent investments. And that doesn't necessarily preclude gold in the portfolio, but it would have to be a very small percentage, let's say low single digits, 1 or 2 or 3%. And the regulators probably wouldn't give you too much grief for that. Again, I think they have it backwards. It's actually the dollar that's going down and up, not gold that's going up and down. Then, of course, there's and this is our favorite of monetary metals, because we pay interest on gold. And we wrote an open letter to Warren Buffett, but there's what I call the Warren Buffett objection, where he says, gold doesn't pay a yield. You buy a lump of metal, you stick it in your desk drawer 20 years later. Not that anybody would put gold in their desk drawer, more like they're safe. But, you take it out 20 years later, it's still the same lump of gold, being neither productive nor procreative, doesn't earn a yield, blah, 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 blah. And of course, we wrote this Dear Mr. Buffett letter, you were correct, but no longer monetary metals pays interest on gold. By financing productive things, that's the kicker to it. So we've overcome that challenge. Then the modern one, the Bitcoiners seem to, and I use the word pivot. So pivot is when somebody makes kind of a lousy argument, and then they run into where somebody actually debunks the argument and answers it properly. The pivot is when somebody doesn't acknowledge that the argument they just gave, which presumably is their best argument. Why Bitcoin? Well, because whatever. And that's their statement, period, full stop. And then it gets debunked. They just don't acknowledge the debunking, and they just smoothly move on to the next argument, as if the first one was never asked and, said and answered. And so the Bitcoiners have pivoted on now to this idea that gold is centralized, Bitcoin is decentralized, gold, therefore, because it's centralized, it's going to be confiscated, and there's the whole miasma of, different syndromes that they allege all come out of this. And of course, they have it exactly backwards. I mean, they don't read history, so they don't know this. The whole point of gold, as I was saying earlier, is that you have the right to take your marbles home. It is the opposite of centralized. The dollar is centralized. Gold absolutely is not. Anybody can, and back in the old days, workers would get their wages counted out in silver, and have the right to take that home and deposit it if and only if the banks were offering a good deal with good risk. So they they come up with this ahistorical, argument, and they say, well, gold is heavy. It's very value dense. This piece of gold would represent probably more than the life savings of 90% of the people, 95% of the people on this planet, and you can stick it in your pocket. I mean, 2 kilos might drag on your trousers a little bit, but you could, right? It's very portable. It's very value dense, and they say, well, it's hard to spot a fake. So in that debate, I actually took out a gold coin I had in my pocket, held the microphone to the table, dropped the coin on the table, and you could hear the ring. Gold is a very unique ring. There's no other metal that comes remotely close to that sound. Certainly not a fake, which would be tungsten or lead or something. We go thunk versus ting. And so those are 3 arguments right there.
All right. Keith Weiner, before we wrap up, can you tell us about Monetary Metals and how people can follow you on social media or perhaps contact you?
So I'm at Real Keith Weiner on Twitter. Our website is monetary-metals.com. Dash is important. We provide accounts people can open, and it's a conventional storage account like anybody else, but the difference is we then present opportunities to lease the gold out, and we actually pay interest on it. So instead of paying storage costs, people can earn interest on their gold. And for people that have decided to own gold for whatever the reasons may be, we think it's a pretty attractive proposition to be able to get paid on that gold and earn some more gold. So lease rates tend to be in the 2 to 3% per annum range. The leases are, we do everything we can to make the risk as low as possible. That is for inventory and work in progress. So the gold is physically present. We could go to the lessee, scrape all the gold, put it on a scale, and it would be greater than the lease amount. It's insured. There's a lot of other things we do. And then we have another program for accredited investors. Interest rates can be much higher. We just announced a bond. So we have issued the first gold bonds since President Roosevelt broke the gold standard in 1933. The point of which, by the way, wasn't to steal the gold. It was to break the gold standard so he can get control of monetary policy, which the government didn't have full control over in those days. So since 1933, there was nothing. Gold was not used to finance production, and we issued this gold bond, and then another, and the one we just did is paying 19%. Obviously, much higher interest rate than the leases, much higher risk. It is a public company that's listed in Norway, but it's for a mine, and the mine is in Ethiopia. So obviously, there's real risks there that you can't just wave your hand and say, "Oh yeah, there's no risk." I mean, there definitely is, but we think well mitigated, and we think that's a fair and appropriate interest rate for it. And we have a variety of things kind of in the middle as well.